Understanding the concept of deemed dividends. Introduction. In corporate finance and taxation, dividends typically refers to the distribution of profits by the company to its shareholders. However, not all the distributions or the financial benefits to the shareholders are straightforward. The Income Tax Act 1961 introduces the concept of deemed dividend under Section 2 subsection 22 to cover the situations where benefits provided to the shareholder resembles dividend payouts even if they are not formally declared as such. The concept plays a crucial role in preventing the tax avoidance strategies, particularly in closely held companies where profits can be distributed indirectly in the disguise of loans, advances, or other benefits. Understanding deemed dividends is essential for the students specializing in finance, taxation, or corporate governance. What is deemed dividend? Deemed dividend refers to certain distribution or the payments made by the company that are treated as a dividends for the tax purposes even though they are not declared as a dividend in the traditional sense. The primary objective is to prevent the shareholders from avoiding tax by receiving company funds in forms other than the declared dividends. According to section 2 subsection 22 of the Income Tax Act, deemed dividend includes the following types of dividends. Deemed dividends has the various types under section 2 subsection 22. Section 2 subsection 22a, distribution of the accumulated profits resulting in the release of assets to the shareholders. Section 2 subsection 22b, distribution of debentures or the deposits of certificates to shareholders out of accumulated profits. Section 2 subsection 22c, distribution on liquidation of a company to the extent of accumulated profits. Section 2 subsection 22d, distribution to the shareholders on the reduction of share capital to the extent of accumulated profits. Section 2 subsection 22e, most important for the students, any loans or advances given by the closely held companies not widely held to a shareholder holding 10% or more voting powers or a concern in which shareholders has a beneficial interest of 20% or more. Such amounts are treated as a deemed dividends but only to the extent of accumulated profit. This is used to stop the shareholders from withdrawing funds as a loan instead of dividends. Exceptions: not treated as a deemed dividend. Deemed dividends does not apply when loans or advances is in ordinary course of business. For example, lending companies. Advances is for the genuine business transactions. Loan is given to a shareholder in return for the commercial benefit. Payment is made to a shareholder in the case of buyback covered separately. Taxation of a deemed dividend. Taxed in the hands of the recipient shareholder. Tax rate is applicable as per the individual slab rates. Section 2 subsection 22e, specifically not covered under dividend distribution tax framework since a dividend distribution tax abolished from the financial year 2021 onwards. Illustrative example: ABC Private Limited is a closely held company with accumulated profits of 50 lakhs. Mr. X holds 20% shares in the company. The company gives him a loan of 10 lakh. Mr. X has a 10% voting rights. Company is closely held. Loan given to a shareholder. Hence, 10 lakhs will be treated as a deemed dividend in the hands of Mr. X. Conclusion: the deemed dividend is a powerful and anti-avoidance tool designed to maintain the transparency and fairness in the corporate distributions. For students or working professional, particular to those who are entering into the corporate advisory, finance, and taxation and management role, understanding deemed dividends ensures the informed decision making and compliance with the tax laws.